Hello, everyone. Welcome to another webinar by Smartkarma. I'm Michael Tegos. Today, I'm happy to welcome back Analyst Kyle Rudden, continuing his series on ESG investing in collaboration with SGX. In this sixth installment of the series, Kyle will examine ESG from alternative angles, as ESG is making its way into other asset classes and non-traditional for ESG situations. Kyle, welcome, and thank you for being with us once again. Over to you.
Thank you. Good evening, everybody. Thank you for participating. As Michael said, it's the sixth in a series of 8 on ESG-related investing. I'll tell you what it's about in a second. First, I just want to get through the quick introduction. Some of you probably been on prior webinars and know this already, but for those that don't, my name is Kyle Rudden. I cover sustainability, ESG investing issues on Smartkarma. I've been doing that for a number of years now. Been doing ESG per se, dedicated ESG for 13, 14 years now. Previously in ESG investment research, index creation, and some consulting work around reporting standards. Prior to that, I was in ESG-like roles, although we didn't use that vernacular, but I covered alternative energy, clean energy, and dirty energy as well. I was head of JP Morgan's, sell-side equity analyst, head of JP Morgan's Global Energy Research Group. So, today's webinar, I didn't know what to call it. Probably clear on the title slide. The topic of this webinar is really not a topic, not a single topic. It's more like a collection of several topics. It's really hard to label. But before I even try to label it, let me step back. Initially, I had planned on doing something like this as the last, or if not the last, the second to last webinar in the series. This is the third to last. It's 2 more. I moved it up, and I'll tell you why. At first, I was really looking at this as kind of an everything else topic, kind of a catch-all, and it still sort of is. But I was really looking at it as just a hodgepodge, and that everything else webinar seemed to fit best towards the end, kind of as a wrap-up. But as I've gotten through a number of these webinars, many of the topics that I broach in this one tonight, they kept coming up in other webinars, either in the course of another ESG subject, kind of like an aside or a tangent, and occasionally as a question posed by the audience. In fact, in the last webinar, someone was asking about ESG and Ukraine, Russia. So it really got me thinking about it. And I decided that the more I thought about it, and the more you asked about it, the more I started to view this as a substantive topic, collection of topics, really, rather than just a catch-all to throw at the end. So that's kind of why I moved it up. It's not organized in any particular order. Usually I do have these things structured in like 3 sections, but that's a lot easier when it's really on one topic. These are multiple topics. There's a lot of overlaps to see, but they're multiple topics. But if anything, the umbrella term, like Michael said in the beginning, is just kind of alternative angles of things. I've mentioned in a number of webinars this concept of the quote unquote mainstreaming of ESG. I probably had it in the first one, the introduction, and I probably mentioned it a few times. Just over the last number of years, how ESG has gone from, its early roots as an obscure investing niche of like tree huggers and Bible thumpers, the ethical investing, people and planet and for-profits kind of motive, with more like philanthropy, where it's gone mainstream, a greater number of investors, and a more pragmatic approach of ESG. It's gone from that niche, the do-good niche, to something more mainstream and diverse, but where alpha generation is not a cardinal sin, where it's more people, planet, and profit. So that's the mainstreaming of ESG I've been talking about. I've covered it ad nauseum, so I won't harp on it now. But what I want to point out in that context is something that's kind of equally interesting, if not more, and it's sort of paradoxical, kind of an opposite trend. It's the unmainstreaming during the mainstream, or the non-mainstreaming, or whatever you want to call it. It's kind of a parallel trend, and it's just the mainstreaming of ESG among non-mainstream or alternative groups, asset classes, investor types, like hedge funds, private equity, venture capital, et cetera, and so forth. Not traditionally ESG related, but also so not just asset classes and investors, but also situations, events, like mergers and acquisitions, IPOs, but also like geopolitical events like Ukraine, and kind of new and unconventional, at least unconventional for ESG, investing and trading strategies. So, when I started kind of writing this and creating slides and scripting and everything, at some point I realized I was sounding like I was reading a white paper from some NGO about sustainable investing and assets under management growth, et cetera, and so forth. So what I decided to do is, it was really difficult to approach it that way. So what I decided to do was just kind of address a number of topics in the context of an example, a particular situation. And at the end of each of these sections, because they are so different, they're interrelated in ways, but it's a collection of different issues. I thought it might make sense at the end of each section just to check with everybody, see if anybody has questions, needs clarification, or whatever. So the first one I'm going to do is kind of transactional ESG, if you will, like ESG making its way into deals, investment banking, IPOs, mergers and acquisitions, more than it ever has been. The next one I'm going to do is talk about, I put it in quotes, near-term ESG. ESG has always been a long-term affair. ESG investing has always been a long-term affair. You'd be crazy if you ever thought generate alpha in under 5 years. This is going back a number of years. But things are changing, and the time horizons for ESG investing are broadening. There are shorter-term opportunities, et cetera, and so forth. So I'm going to talk about that. The concept of short selling, I know we've talked about it in the series, but in the context of just kind of like quote unquote traditional or quote unquote regular long short strategies, we'll talk about something a little bit different here, which is a trend that the hedge funds seem to want to use shorting carbon emitters as a carbon accounting method to achieve portfolio carbon neutrality, which is a bit crazy. But touch on that. I mean, again, it's not that I'm necessarily talking about the specific issue, but it's a particular real world and kind of interesting example that touches on a few things. It touches on hedge funds getting into ESG, and it touches on near-term strategies, et cetera, and so forth. When I get into these, you'll see kind of what I'm talking about. And the last one, I figured I'd just touch on the triple bottom line of war, ESG and triple bottom line aspects of such a significant conflict. Because quite honestly, ESG hasn't been around all that long, depending on where you are, Europe, US, Asia, 25 years, 15 years to no years. There hasn't been a real large scale war while ESG was hot and mainstream. So it's kind of new territory and people trying to figure it out. And there's some interesting issues. Dealing in ESG or ESG in deals, ESG integration in IPOs, mergers and acquisitions, et cetera, and so forth. It's nothing super new. Yes, companies that are inclined to talk about ESG, like let's say a wind power company, they've been talking about ESG for decades. We weren't using the acronym decades ago, but they've been talking about those issues. But I'm talking here about companies that 5 years ago wouldn't have ever mentioned ESG, that are dealing with it early on in the process, pre-IPO. They get to mergers and acquisitions in a second. That's actually less of a focus here. Or early on in the pre-IPO process, it's tough to do, right? Particularly if you're a more traditional pre-IPO company, like a smaller startup that's getting to that phase. There are exceptions, like Aramco, like Thai Bev, like a number of these, like Lick, where these companies that aren't public, they're pre-IPO, they're going public, but they're by no means small startups. But I'm talking about the run-of-the-mill pre-IPO company getting more and more interested in creating an ESG narrative before the IPO. So we can talk about it in the roadshow, et cetera, and so forth. ESG is playing, a really important role in IPOs. I've published a number of reports on it on Smartkarma. So suggest you look at those, just the kind of thematic reports on ESG in the IPO context, and then a few issuer-specific, IPO-specific analyses. But there are a lot of forces here. I mean, investors are demanding it. Particularly a lot of the big pension funds, retirement funds. Most of those are inclined to be ESG minded, and they're big buyers of deals. Stock exchanges like Hong Kong Exchange are increasingly requiring pre-IPO issuers to disclose ESG data, perhaps not as much as an established listed issuer, but that's kind of a new thing that didn't exist 5-6 years ago. Exchanges requiring ESG disclosures as part of the IPO registration process. Investors are grilling managements on IPO roadshows, and the way that a management answers those, or doesn't, the way they react has had some pretty significant ramifications for deals. And I'll go into a couple examples in a second. Usually by altering the IPO, the pricing, the valuation, or maybe changing roadshow schedules. There haven't been any major cancellations, but there have been some major blowups. But pre-IPO ESG narratives and the ability to answer questions and that kind of thing can have impacts not just on the IPO, on like investor interest, book building, pricing, but also post-IPO trading evaluation. But one particularly important issue is ESG index inclusion. As ESG and sustainability indexes and index-linked products grow and AUM grows, everybody wants to be a constituent. Obviously, that can help valuation, but the flows can help valuation. But it's about more than that for a lot of these companies. I don't want to say bragging rights, but it's about prestige. Like LIC, the life insurance company of India, first ever, the government and LIC are pursuing pre-IPO ESG ratings. Now, I wrote a report on that on Smartkarma questioning the logic behind that, because it just, to me, it seems like there's more that could go wrong with such a short time frame. And they don't really need ratings per se to tell the story. I just felt that they were pushing too hard for something that's too hard, too fast, for something that takes a long time to actually do, and it could backfire when the return isn't significant. Not that they shouldn't do it long term, but anyway, that's just an example of a really big company and a government of one of the largest countries in the world proactively pushing ESG for one of their IPOs. The investment banking world is also integrating ESG pretty rapidly, and I'm not talking about ESG exclusions for like fossil fuel lending or palm oil lending or anything like that. I mean, that's still very relevant. I'm talking about mergers and acquisitions predominantly here, because in the investment banking world, that's where I see it most kind of thoroughly integrated, kind of ESG first approaches and thoroughly integrated into the process of, from working with acquirers to target acquisition to negotiations and due diligence and even post-merger integration and operations and that kind of thing. Most banks, obviously the big ones, I see a lot of Goldman Sachs, JP Morgan, but it's really a big trend, and there have been a number of studies and surveys where you can kind of sense that even though this is happening now, that it's be picking up a lot, and there are a lot of reasons for that. I mean, there are potentially big risks, ESG-related risks in M&A, valuation risks, operational risks, et cetera, and so forth. And there's some evidence that taking kind of an ESG approach to M&A and doing ESG-centric consequence analyses and that kind of thing can actually produce better results, tighter, quicker strategic integration, achieving synergies that are expected, that sort of thing. But I want to get back to the IPOs, just to kind of give you a quick feel for some real world examples of how ESG pre-IPO and in a couple cases here post-IPO really had a significant impact. One of which is Saudi Aramco. That was one of the world's biggest IPOs. It was a number of years ago now. I also wrote a pretty in-depth report on that IPO on Smartkarma, so if you're interested, take a look at it. But that one was interesting. I mean, it was an ESG nightmare off the bat. I mean, I knew when they announced it, it was going to be a fun report to write. You have got, the biggest oil company in the world and, the Saudi government. And at the time, I don't know if Khashoggi had just been killed or shortly after, and there's all sorts of human rights stuff in the news. They had recently, an oil field had been nuked, not nuked, but hit by the missile by Yemen or something. It was an absolute ESG mess at the time. And that came out during the roadshow. They had initially wanted, the prince wanted to, as part of his, like, I don't know what he called it, Green New Plan or whatever. And he was really excited about it. He wanted to raise, touting, renewables and clean oil refining and everything. No one was buying it. And it was supposed to be a $2 billion valuation. They were getting grilled by foreign investors, particularly in Europe, about ESG issues. They were shocked. They knew they'd be getting them on the environmental side. They didn't realize how focused people would be on human rights. And they eventually had to scale back to almost nothing the international side of the roadshow. And then they scaled the deal back because they didn't have the big foreign anchor investors they thought they might have, the big institutions like L&G and CalPERS in the United States and whatever else. So that wound up, it was still a monstrous deal, $1.7 billion, but it was $300 billion effectively left on the table because of ESG concerns. Deliveroo was another one, not nearly as big, but UK-based online food delivery startup. So Saudi Aramco is one of those examples of an established company doing an IPO. This is more of a traditional, grow till you're ready to raise capital and do an IPO route. So March 2021 was a $10 billion deal. It was like 10 and a half US, 7.8 or so billion pounds. This one was interesting. Aside from the fact that it lost 30% of its value on the first day, somewhere intraday on the first day, I think it probably closed it like down 2.8 billion or something like that, but basically down 30% on day one of IPO trading. Much of that loss had to do with ESG issues. It wasn't entirely ESG, but it was substantially ESG and substantially social pillar issues that were, about, the whole gig economy workers' rights stuff, where you got drivers that aren't salaried and they don't get benefits and they're not treated right and they're docked pay if they're late or whatever, all that kind of stuff. It's come up with DD. It's a pretty common issue. But big investors, Viva, L&G, M&G, had expressed explicitly in ESG terms, using ESG, et cetera, and so forth, had expressed concerns, backed away for each of those for slightly different reasons, for all ESG reasons. And subsequently, the stock's down another 50% in the last year or so. It's got hit with a couple of small lawsuits, but it's still dealing fundamentally with some of those social pillar issues, labor relations, workers' rights, whatever you want to call it. Some of them, to be honest with you, are typical for a company like that. They're growing pains. One issue with IPOs, particularly this route, not the Aramco route. When you're a startup and you're growing, you usually don't have the money or the time to focus on ESG like an established listed company would. Maybe you do a little bit of it, but you're really out there growing the company and getting to the point where you're doing the IPO. So some of this has to be forgiven, but they've had a pretty rocky road. Allbirds, another 2021 IPO. This one's Asia Pacific, New Zealand. It's a footwear and apparel company. They make the hippie stuff, recyclable materials and don't use these chemicals, et cetera, and so forth. They really, prior to the IPO, and I almost feel bad. It's like that kid that tries so hard at something but fails. You want to give him credit for trying. This was the ultimate greenwashing prospectus. It was just chock full, riddled with ESG vernacular for the sake of ESG vernacular. And while the company is definitely has eco-friendly products and it definitely has a real, genuine sustainability vision and concern and everything, it went overboard. The reality or truth is good enough. They should have just stuck with it, but they felt the need to just go overboard, and they got forced by the SEC to because of kind of labeling and terminology that was a little too green. They were forced by the SEC to rewrite the prospectus several times. They were told to cut back on all the green language, so they pulled out hundreds of related words, green and sustainable, et cetera, and so forth, just where it was being overused. And I think more interestingly, they were told to restate misrepresented ESG and sustainability claims, like that. They had made comments or claims about the carbon footprint of their shoes or their products, but didn't at all include scope 3 emissions, et cetera, and so forth. So it was a lot of stretching the truth. There were some real truths in there, but a lot of stretching the truth. And they ultimately got hit with a pretty big class action lawsuit by both investors and customers, claiming they misrepresented the sustainability aspects of their products. And that stuff's had a rough run. Can't remember what it is, but it's down way off IPO levels. Had the numbers before, but down to like $6 and something cents from, I don't even remember what it was, 20, 30, 40, but down significantly. There are other examples it's actually another topic I probably could have put in here, but is an increasing, if you were on the last webinar, I mentioned it briefly, a palpable increase in sustainability and ESG related lawsuits, particularly related to climate claims. And there are other examples of IPOs that had a rough time because of ESG issues, but these stand out because they were pretty significant, and each of these were slightly different. I figured it would kind of give you, a flavor for these. So I call this near-term ESG. It's really, like I said, I didn't want to, zip through topics and sound like an NGO white paper. So I figured I'd try to package these things in a slightly different way. So I just labeled this near-term ESG, but really what this is it's about, so in the beginning of the webinar, I mentioned the alternative mainstream or the non-mainstream mainstream. I mentioned unconventional, for ESG, unconventional investors and asset classes, so like venture capital, hedge funds, private equity, et cetera. I mentioned sort of unconventional for ESG situations and events. And then the last one I mentioned was kind of new or atypical or unconventional for ESG trading, investing opportunities and strategies. So this kind of hits a couple things. The biggest intersection is the ESG data problem, which I covered in the last two webinars. But one aspect in particular, which is timeliness of ESG data. So it's the intersection of that ESG data problem and the solution to that problem, and the entree of different kinds of investors like hedge funds. I'll get to that in a second. So I'm not going to get into the whole data problem, but one of the ESG data problems is a collection of flaws inherent in ESG data that have been an impediment to greater adoption and alpha generation, or at least proving ESG alpha exists and that kind of thing. But so it's a collection of problems. One of the big problems has, and still is, but it's getting better, is the timeliness of ESG data. It's non-financial data. It's not regulated. That's changing. So I'm going back like 5 years. Historically, it hasn't been regulated at all. That is changing. It's partially regulated now. It's getting better, but some of the legacy problems linger. It takes time to work out, and one of them is timeliness. ESG data being not regulated, particularly in the past, companies have released it if they felt like it. If they didn't disclose anything. If they did, they did it whenever they decided to, whenever they wanted to. You couldn't predict. Now there's a little bit more predictability because many companies are doing either publishing an ESG report, say a sustainability / ESG report, simultaneously with an annual report, or publishing a single integrated report, and that seems to be the trend. So the predictability is getting better, but it's still just once annually. You might get like quarterly data supplement updates or something like that, but it's at best quarterly. And if we're using this to invest, that's a problem because stock markets move in real time. So quarterly data, for our hourly study, not even hourly, second ticks, minute ticks, it just doesn't work. That's improving, which is what I'm getting to this near-term thing. We're not there yet, but the problem of timeliness is becoming a solution of timeliness. Companies are getting better, as I said, at reporting more regularly and more consistently. But more importantly is, I say on the slide, a new breed of third-party ESG data providers, but also a new mentality, not just product providers. But I'm talking about like fintech-like startups, like not MSCI, not S&P, not Refinitiv, not the big behemoth ESG data providers. They're getting better at real-time updates too, but they create indices for investment products, and you can't have an ETF linked to an index and rebalance the index every hour. It's just not going to work. So there was a void for something else that's being filled by this new breed of tech-savvy kind of fintech ESG companies. And what's important is that a number of things important. They predominantly focus on information technology, machine learning, alternative data, like satellite imagery and social media feeds and natural language processing, that kind of thing. which is far more conducive to real-time ESG information and intelligence. Much of it is truly real-time. Whether or not the material metrics are real-time, it really depends. But if they're not real-time, they're like on a daily basis, much better than quarterly or annual. And importantly, these companies are fresh business models. They're not entrenched ESG data providers or index providers. They're tech firms, and they're not, as far as I know, not looking necessarily to license indices and get the linked AUM up. They're about the technology and about the data, and that's what they're selling. So their hands aren't tied in ways that others are. So that's really changing things for ESG in a pretty big way. Aside from the fact that there's more data available and it's being democratized, it's not owned and controlled by what's effectively a monopoly, that sort of MSCI or Refinitiv S&P. I got the market cornered on certain things. So it's a new, fresh game. Consider it like the independent research of ESG. And again, the most important thing is that it's taking the quarterly to annual update window down to anywhere from seconds to days, depending on the sector, the kind of metric. And you can do a lot of things with that you can't do from an investing standpoint with quarterly data or annual data. So historically, up until recently, ESG investing was long-only equity, long-term long-only equity, right? Fixed income here or there, but it was pretty much a long equity game and very long-term. And I started looking at ESG alpha connections 10, 12 years ago, we weren't seeing, any evidence until close to a decade out in terms of back tests. In some cases, 5 years, but that 5 years was short term back then. Maybe you're looking at a few years for most ESG investing now, not 10, but the real short term windows didn't exist at all for ESG. Kind of a buy and hold thing. It's a medium term at the shortest, largely due to the disconnect of ESG data and markets, but also in terms of timing disconnects between ESG related actions by corporates, by issuers, and the results. ESG stuff has to work its way through the corporation before it manifests in equity alpha or lower cost of capital or whatever. So there's a lot of do and waiting. You're doing and then waiting. That's changing. And the savior is alternative data and these new technology firms and just the overall trend. Real-time ESG data and intelligence is the ultimate game changer. We're not stuck in that 5 to 10 year window. You can start looking at things closer to today. I don't know about day trading and programmatic trade, ESG trading yet, but you can definitely start looking at ESG as not just ESG investing, but maybe ESG trading. You can start thinking about ESG in a risk arbitrage sense, and a lot of shorter term opportunistic trading kind of ways, as opposed to quote unquote investing. Shorter term positions, shorting, which I've mentioned a couple of times, and I'll get into a little bit more in a second. Shorting's historically been kind of a taboo in ESG circles, but as it's gone mainstream, it's more acceptable. I mean, talking about just like hedging and traditional long shorts, as opposed to what I'm going to get into about carbon accounting. So even shorting's you're more expected. That Japan pension fund a while back had suspended it and then reinstated it. It's just and there was no proof that it was about borrowing shares for shorting, but that was the undercurrents, and it's just become more acceptable. And quant strategies, again, the machine learning, AI, alternative data, quant strategies are on the rise, particularly as hedge funds get in. This is just another example of how all these things I'm talking about kind of overlap. So right now I'm talking about new data providers, I'm talking about hedge funds, I'm talking about new investment strategies. So there's a lot of kind of intersection overlap, but quantitative ESG strategies are they've been around for a while, but they always had their hands tied behind their back because of the data timeliness, lack of certain kinds of data and the timeliness of it. Now we're drowning in data and we're getting it a lot faster. So those kinds of strategies become more viable. Anyway. All right, so shorting ESG. This is just, I'm touching on a couple of things here. I'm touching on the influx of hedge funds generally, but then this weird trend. But the title is shorting ESG or short selling ESG, and that actually is a broader topic. I touched on it very briefly. Just to summarize the more generic version of shorting ESG, hedge funds or otherwise, historically it's been taboo in ESG circles that it's bad. Same reasons as it's taboo anywhere else if it is, but just exacerbated. It's not the ethical thing to do, and so on and so forth. But that was then. That was years ago when it was a niche group of tree huggers and Bible thumpers. Now it's mainstream investors, more mainstream investors, using ESG as another tool in the toolbox, where where returns are important, alpha generation is important. In one of my early presentations, I had a chart. There are other variants of it out there. You've probably seen it. It's a pyramid, and there's kind of like an alpha, ESG impact continuum or trade-off, where philanthropy is at the top. Charity's way at the top. There's no concern about return there. Philanthropy is concerned about managing assets and money, but it's not a profit motive necessarily. And then you got impact investing and all the way down to ESG integration, which is kind of an alpha first, or it's not do good even at the expense of lower returns. It's a little bit of both. The concept of double materiality. So short selling, kind of in a traditional sense, it's a matter of personal opinion. I personally feel that done responsibly, it has its place in any kind of ESG related investing. What I have here isn't responsible. I'll get to, but first, hedge funds in ESG. The ESG party has been booming for years. It was started by the commune of tree huggers, the niche funds years and years and years ago. Started to go more mainstream. It kind of the ethical investing group, the social responsible investing group, and now it's kind of completely mainstream. But we're talking about mainstream investors in kind of more mainstream kinds of investments and entities and asset classes. We're talking about mutual funds and ETFs and pension funds and that kind of thing. The alternatives, the fringes, that hedge funds, venture capital, private equity, family offices, the REITs, a little bit, not so much REITs, but the fringe groups were latecomers. And for a number of reasons, many of which are pragmatic. It probably didn't make sense for hedge funds to get in much earlier. And they're good at kind of sitting by the sidelines and watching and learning before they do anything. But they're making up for lost time. They're late to the party, but they're making up for lost time. It's small, relatively speaking, within the ESG ecosystem, and whatever big total assets under management for ESG number you want to take. Bloomberg's got whatever it is, 50-something billion, and USSIF has some other numbers of billions. It's tens of billions under management that's somehow linked to ESG. Globally, all asset classes, et cetera, and so forth. Hedge funds probably don't show up on that pie chart in terms of absolute AUM, but relatively speaking, relative to the hedge fund industry, they're getting involved. The last, and this is probably dated by a few months, but the last report I saw was about $1 billion in hedge fund AUM, and that might have just been US, Europe. I don't know, I have to go back and find the report, but it's a decent enough number. And it's a decent enough number when just a few years ago, the number was zero. And the funds vary. You get some activist hedge funds, you've got some hedge fund-like funds, like hedge fund-like ETFs that are more activist. It's kind of the traditional long short. You've got hedge funds that aren't doing this to save the world. They're not necessarily ESG linked assets. They're ESG curious. They don't want to miss something. They're opportunistic. It really runs the gamut. But this one strategy I want to talk about, and it's not a particular company strategy or fund specific strategy. It's just a strategy that's really making the rounds in the hedge fund world, and the hedge fund world's getting a lot of criticism for it from others in the ESG space. It's basically it's really simple. The idea is, they want to say their portfolio is net zero, carbon neutral and net zero. They have reasons to do that. Customers might ask, but it's expensive to get there potentially, and they've kind of figured out that, well, if we short, as getting quite a bit to the question of offsetting, if we short big carbon emitters, so let's say we've got a couple carbon emitters, big oil, we want some energy exposure, we like Chevron, but we hate Exxon Mobil, whatever the case may be. You short carbon emitters, and that counts COUNTS and accounts for carbon offsetting, and that theoretically you could have a carbon neutral portfolio, even though you've not done a damn thing to take an ounce of carbon out of the atmosphere or anything like that. You're offsetting, and you're passing the buck to someone else, or the fund is passing the buck to someone else. And the debate's pretty hot. I don't know how far this is going to go. There are, the idea of doing this as a carbon offset, a permanent one, I think is ridiculous. There are plenty of reasons the hedge fund should be shorting based upon ESG, legit reasons, speculating, making money, de-risking, even specifically shorting the carbon intensive stocks I'm talking about here. It could be smart financial de-risking, like a big, an Exxon has got a ton of climate risk related to its business. We might not know what the number is, so by shorting, you're de-risking, but to short to achieve portfolio carbon neutrality for your hedge fund is ridiculous, I think. But anyway, and it's ridiculous because no one's talking about doing it temporarily, which kind of gets to the point I was going to bring up. But the question is that carbon offsetting is legitimate to an extent. There are differences in offset programs and everything, but there's some things that are the shady side of the offsetting business, the used car salesman kind of stuff. But most of it's legit, but it's a short-term fix. It's a, like I said, it doesn't, generally speaking, a lot of things don't take carbon out of the atmosphere. Some things go a long way in putting a lot less into the atmosphere. Some things help, if you're planting trees, you're creating natural carbon sinks, but in the end, what's most important is reducing carbon and other greenhouse gas emissions, but carbon emissions. Offsetting is part of the strategy to get there, but it's not a permanent solution. War in the Ukraine and Russia. Like I said before, there's always a skirmish going on somewhere in the world. But in terms of a real large-scale conflict at its peak, I'm particularly aware of U.S. and everything. I know when we were like totally winding down, and I'm not talking about the recent Afghanistan debacle, but I'm talking about combat troops in Iraq and Afghanistan, combat phase stuff like in 2010, 2011. I was just starting with ESG then. There really hasn't been a conflict of this scale, and not just the Ukraine's a small country, but I'm talking about the scale. I'm talking about this geopolitical scale and the ramifications. There's not been something like this during a time where ESG was so mainstream. Like the last time something like this happened, ESG was still niche. So it's really interesting. It's new, kind of uncharted territory in many respects. And it's really multifaceted and complicated. I've got a number of questions, like I said, one on a webinar, and a number via email about this. It's kind of Ukraine and ESG. These are more kind of somewhat random observations, but related. So the first thing that comes to mind, just in terms of war and ESG, is controversial weapons, right? As a screen or as a scene stock. But before I get into that kind of stuff, I just want to point out that this is, I said on the title side, a cluster bomb of TBO issues. It really hits all pillars, right? So the triple bottom line, in case people aren't aware of it, it's a full cost accounting method that's kind of been borrowed by the sustainability ESG world. It's basically ESG plus another pillar, right? So ESG is environmental, social, and governance technically without any consideration of financial and economic factors. Triple bottom line is ESG plus financial factors or economic factors, whatever term you want to use. And technically, the triple bottom line, triple three, pillar one is environmental, pillar two is social, which includes governance, and pillar three is economic. It's people, planet, and profit. My point here is, and I broke on the right side, I broke it down before just because it's clear, that war, and particularly this war, hits on all pillars and hits them hard. I mean, social is number one, humanitarian issues at the top, talking about people dying, on both sides, civilians and military personnel. All war is bad. And then if they're not getting killed, there are other issues, homelessness and lack of potable water and food, and all these ESG issues and global sustainability issues like availability of potable water, right? That's a big one. There are sustainable development goals about it. There are index funds that are water funds. It's a big issue, and overnight you can create a really big problem with war. There are environmental impacts. Russia's military vehicles aren't hybrids or EVs. They're spewing smoke. Ordnance has a lot of heavy metals in it and other toxic chemicals. Not to mention unexploded ordnance, particularly cluster bombs. That's a social issue, and these all overlap. If you've seen any of the videos, you think like agriculture in Southeast Asia is bad for deforestation and land clearing by burning. I mean, just watch some of the Ukraine videos. Deforestation by heavy metals and toxic chemicals, and there are other issues that Chernobyl was a concern for a while. So environmental impacts, while they're not the most obvious necessarily, particularly when you see people getting killed, you don't think about the environment right away, but they're big environmental politics, and of course governance, across the board. It's a global geopolitical mess. Putin and Biden doesn't know what to do with this, and Europe's confused, and there are like economic interests and then social feelings like we should be doing this, we shouldn't be doing this. Companies were initially slow to pull out of Russia, some haven't. It's a geopolitical mess, and it creates future geopolitical conflict and confusion. And it's Russia and Ukraine and Europe, but then there's the US and China. It's just really complex. So governance is involved, and then economics, economic sanctions off the bat. I mean, that's what comes to mind, crippling, right? But that's also a social issue, right? Russian population, Vladimir Putin may have asked for sanctions or had to expect sanctions, but the general population is suffering for something they probably had nothing to do with and might have disagreed with. Those economic sanctions are going to cause other hardships, healthcare system, shortfalls and disease. Some of it goes on long enough. So there are the four pillars, right? Four triple bottom line pillars, technically three, but and you can kind of see the interrelations of all of them. But I was just going to go through a few more kind of war-related issues. One being the issue of I was going to talk about the issue of controversial weapons as a sin stock, or defense contractors that produce controversial weapons and munitions. That's a sin stock, right? So sin stocks back in the day of ethical ESG investing, it's like pornography, alcohol, tobacco, gambling, controversial weapons, and probably a couple other things. Controversial weapons being really military grade weapons of mass destruction, not the Browning hunting rifle that someone's going to use in Northern Europe to go get Christmas dinner or whatever they do. I'm talking about cluster bombs and nuclear warheads and landmines and all that kind of stuff. Military grade munitions with significant potential to harm masses of innocent civilians, that sort of thing. That's historically been a sin stock, but and no one's ever questioned it. Those are bad. And if you look at, I've been doing a big research project on Southeast Asian banks and their policies, and I've been picking apart exclusionary lists, what kind of projects they won't finance or clients they won't finance or thresholds they need to meet. And all of them have very predictable exclusions. And top of the list is controversial weapons of all sorts. What surprised me, though, is so it's never been an issue. Everybody's kind of been in agreement that nuclear war is bad and cluster bombs, landing in a civilian apartment block is bad. But suddenly the debate the conversation is divided, and there are two sides to it, and it's really confusing and contradictory. So depending on who's your team, are you a fan of Vlad in Russia, or are you rooting for the Ukrainians, right? So suddenly military weapons and munitions can be good for one side and not the other, right? It can be used by one side to kill the other, or some of the weapons could be used by the other side to not get killed by the other by killing them first. All right. So there's this kind of perverse argument that I've never seen before, that during times of war, should these defense stocks and manufacturers of controversial weapons that have forever historically been in the sin stock category, should they be taken out of the sin stock category during times of war if they provide weapons that help the Ukrainians, or if they provide weapons or technology that's going to help Putin's forces get back in order and on the game. It's just amazing. It's never been like that, and it's a lose-lose. It really, particularly if you've got a person on both sides kind of arguing that issue. There aren't many other ESG issues such as those I meant that are controversial of being debated. I mean, they're bad, right? War is bad for the social pillar. War kills people. No one's really debating whether or not the effect of war on social issues is a bad thing. But with weapons, the controversial weapons categories and stocks, it's amazing. I don't know. No one's really taken action on it. When I say no one, I'm talking about like MSCI or Refinitiv. No one's taken action on that, but it'd be interesting to see if someone does, and that suddenly comes out of like Sustainalytics assessment of controversial products or businesses. If you've read enough index methodologies, you know that controversial business screens or product screens are often a preliminary screen. So if that suddenly gets pulled or reduced, it could be a lot of changes in index constituents or weightings. It has a lot of potential. I don't think it's going to go anywhere. I have a feeling this thing's going to end in terms of active combat and everything relatively soon. If this thing were to drag on for 5 or 10 years, we might see big changes on the ESG side. But I don't think that it's going to last long enough that you'll see MSCI changing it. But my point is, though, that the conversation has gotten hot enough and real enough that I could see potentially or conceivably this war changing the way that controversy is treated, and the way ESG scores are calculated, and the way indexes are constituted and weighted, and assets on their specific holdings for all the AUM linked to these indexes. So you never know. That was it. I did have 1 or 2 more points, but they weren't critical. If there are any questions you need clarification on, I'd be happy to answer.
You seem to have covered all the bases here, Kyle. So an attendee asks, since there isn't a structured format for ESG reporting for companies, how can beginner investors look into companies that claim to be part of the ESG umbrella, as it can be mistaken as their efforts for UNSDG? And what is your take on companies that may be pollutive in nature, but take part in carbon credit exchange or any forms of green adoption? So 2-part question here. I can repeat the 2 parts if you need me to, Kyle. So
how does an investor new to ESG ascertain whether or not the company's greenwashing, basically?
That would be my understanding, yes.
Okay. A number of ways. First and foremost, if you're looking at however they disclose, if they disclose a separate sustainability report, or if you're looking at an integrated annual report with the sustainability information in it, look and see if, and it's usually towards the end, like when you see the auditor sign off on something, look and see if they have assurance. So basically, sustainability and ESG data can be audited by a third party and signed off on. A lot like, and I say that carefully, I'll caveat it in a second, but a lot like a regular auditor, like Deloitte or PricewaterhouseCoopers or whatever, PwC. But the issue there is that's not regulated, so you don't have to be a CPA to do an ESG audit. You could be, technically, I could say, hey, I've been covering this stuff for 14 years, 13 years. I'm an ESG expert. I'm going to start, providing insurance. I probably never get my first client, but there's nothing keeping like MSCI, for example, to start doing assurance. I think that would be a bad business decision on that part, but they've got the name recognition, the brand, the clout. They could probably break into it. And there's nothing legally or regulatory wise holding them back. That's going to change soon. But for the most part, companies that do get insurance from a pretty big name. So the same big accounting houses that do financial audits and sign off are also doing ESG and sustainability. And they either subcontract out to like carbon emissions experts, engineers, et cetera, and so forth, or they have them in-house or whatever. But so the first step is look and see if they have insurance, because if they have assurance at the end, it's basically saying, I, such and such a firm, have reviewed their scope 1, 2, and 3 carbon emissions, and we certify that they're accurate within X percent, et cetera, and so forth. Most of them are by reputable names. So even though like an E&Y isn't necessarily licensed or certified, or they didn't take an ESG test, it's still a pretty reputable firm, and they're not going to risk anything by not knowing their stuff and signing off on something. So that's the easiest and first step. Unfortunately, not every company does have assurance. They don't, for 2 main reasons. One, they wouldn't get it, and not necessarily because they're lying or anything like that, but they haven't dotted all their I's and crossed all their T's, particularly if the company's new to reporting. Another issue is that it's expensive. So if it's a smaller firm that probably can't even afford to put together that sustainability report in the first place, it's just another cost that isn't required. Depending on what companies you're looking at, what sectors, how large the companies are, what markets, you have problems finding assurance for some of them, but that's the place to start. And then do cross checks, like sanity checks, due diligence. There was an article, and I bookmarked it. I haven't yet read it, so I'm only going by a summary paragraph in the title. But a consulting firm, I want to say it was in Europe somewhere, just published a pretty big report that's making waves. It was on, Exxon was the one that ExxonMobil was the one that caught my eye, but there were a couple other ones in there. And basically what they did was they took the reported emissions and just did a lot of cross-checking, sanity checking. So carbon intensity, so carbon emissions, absolute emissions measured in tons or megatons or gigatons, and carbon intensity is that tonnage with a denominator of some sort, either a unit of revenue, like tons of carbon per $1 million of revenue, or per hectoliters of palm oil, or square footage of REIT space, or whatever. So what they found was that these companies were grossly understating, these big oils, grossly understating emissions, and they did that by just doing a lot of cross-checking. It's like looking up at the telescope in space and seeing something by not seeing it. It's like what's not there, what you can't see tells you what's there or what's behind it. They did the same thing. They said, well, okay, they're reporting carbon intensity ratios of X, but they had revenues of Y that year. Something's not making sense. So the comps, et cetera, sort of, they just kept triangulating. Sanity checks, common sense, due diligence, that sort of thing. And beyond that, it's probably a can of worms about to open up. But there are other, like when you look at when I say a report, a sustainability report, or the company's sustainability presence on their website, or the analyst presentation gig, whatever the context is, if you do this just a little bit longer and aren't brand new to it, it's almost a sixth sense. You can kind of tell, well, when there's some greenwashing, or green hushing is the new thing, right? So greenwashing is when they're very vocal about green. We're doing green things, we're doing green things. Green hushing is when they kind of hope they don't say anything, they don't put it in the report, and they hope you don't know about it or don't find out about it. But just very quickly, one last point. So if you're looking at a sustainability report, there's no assurance at the end. You did whatever cross-checking you can do. Little signs, like if the report calls itself a sustainability or ESG report, but it still reads like a corporate social responsibility report from 5 years ago, where there are 5 glossy pages on the orangutans they saved, and then 5 glossy pages on the one solar panel they put on the roof, and that's it. Then you really need to start questioning if the data, the numbers, whatever emissions or female board members, or if the data is in the text, right? So like if there's a paragraph that says, we cut carbon emissions from X to Y, blah, blah. If it's only in the text and there are no supporting charts and tables that make it really easy to get at, that's another red flag. Found that I've actually did a study that depending on where information appears, early in the report or far back in the report, whether it's in text, tables, charts, and whether the charts and tables are images in the PDF or they're actually text that you can pull out of the PDF. There's big correlations between those and inaccurate numbers or kind of major ESG, like public relations blunders down the road. So those are my 3 points on that.
What is your take on companies that may be pollutive in nature, but take part in carbon credit exchange or any other forms of green adoption?
Yeah, so give you a couple points just to really quickly. Good for them if it's a part of a short-term strategy, and if it's right, it's better than nothing. Plenty of companies that are doing nothing. So if it's part of a strategy, right, and not a big part, like I'd rather, this could also be answering, the other part of the question. So for someone that's new to ESG and trying to get a sense for whether or not they're getting the wool pulled over their eyes, if someone has a net zero commitment or promise out there, and it's 95% planting trees in Brazil and 5% reducing their own emissions, you certainly have to question the net zero target, but also question a lot of the other things that are coming from the company. So it legitimate short-term strategy. They're short to medium term, right? If it's going to take 10 years to decarbonize, and you want to do offsets for the first half of that, that's a necessary evil in this world. It's better than nothing. Just make sure that my opinion is that one would want to make sure that the company, the issuer, doesn't overly rely on offsets, and that they don't spin their offsetting in a misleading way. So like there are big tech companies out there that, and some financials that they can get away, I don't say get away with, you got to be careful with certain sectors regarding emissions, right? So financials and like tech, scope 1 emissions is what you actually generate yourself. So a widget manufacturer, is going to produce a lot of scope 1 emissions, but a bank isn't, right? They're running computers and it's probably not even their service, their data center and servers, probably outsourcing. So banks and tech firms don't have big scope 1 carbon footprints, but they can have big scope 3 carbon footprints, which scope 3 being, scope 2 is indirect emissions, but from energy use. So if you buy electricity from the utility, scope 2 is the utility burning coal or whatever. Scope 3 is every other indirect emissions. It includes your supply chain and people, that buy your product and eat all the candy and then throw the box away. Where does the box go? Does it get landfilled, incinerated? So within scope 3 are some big numbers, right? So banks, their financed emissions. Now, so take a big bank in Southeast Asia that's involved in palm oil or coal. They do a lot of lending, billions of dollars. They don't report scope 3. They might not report scope 3. So their emissions and the numbers could be really low. But if you count scope 3 and all the emissions that they finance, so their client, palm oil company A's scope 1 emissions is Bank A's scope 3 emissions, or part of Bank A's scope 3 emissions. So getting back to the offsetting thing, if they use offsets to thump their chest and say we're doing great and we're going to be net zero or carbon neutral, there's a slight subtle difference, but we're going to be carbon neutral in 10 years, and it's all offsets, and it's all offsets in maybe questionable ways or not the most ideal ways. There's a spectrum of quality. So I just, part of a temporary strategy, and don't be a jerk when doing it, because too many companies take it as a PR opportunity and spin something that doesn't exist. It's greenwashing, and that's a problem. It's much better. Honestly, it's much better for their valuations, their stock price, their reputation, if they're honest. I've seen companies that are egregious carbon emitters do better by being upfront and honest and saying, yeah, God, our legacy assets are dirty, but we're doing everything we can, and they follow through and they keep you updated and provide data. Then you got a company that kind of is really clean with whatever their sector. They're not big emitters, but they start stretching the truth a little bit here, and it's a total opposite effect. So, like everything in the ESG world, in moderation. Offsetting is okay, but offsetting is often abused, and that's when it's a problem. So actual reductions in emissions are most important. Carbon capture, sequestration, all that kind of stuff is more valuable in the overall equation than offsetting, because offsetting is for the most part either passing the buck or delaying something. It's not solving the problem that's right in front of us. But if everybody said we have to just cut emissions, let's not waste time with offsetting, we'd never get to solving that problem. So it's an important part of the solution, but it can't be a big part of the solution. That's all.
Thank you very much for that, Kyle. In the interest of time, we'll have to leave it there. So thank you, everyone who attended, and thank you, Kyle, for your thorough presentation. If there are any other questions, you can send them either directly to Kyle, or you can email us at research@smartkarma.com, and we will make sure to share them with Kyle. If you want to engage Kyle for bespoke research requests, you can contact your Smartkarma account manager, and they can help you out in this regard. I would also encourage you to follow Kyle's profile on Smartkarma so that you don't miss any of the insights that he publishes. And stay tuned for more announcements for the next parts of Kyle's ESG investing series. We will be also linking to the previous sessions on the registration page as well. Finally, thank you to SGX for helping organize this webinar. And thank you once again to Kyle for your time today and for sharing your insights.
Yeah, absolutely. If anybody does have any follow-up questions or needs clarification, don't hesitate to contact. Even if it's a really simple question, because I know this one was kind of all over the place, and it's understandable if you want to follow up. I'm happy to answer them, and I'm here.